All right, so March 2025, huh? I feel like investors just went through like 10 rounds in a financial boxing ring.
Yeah, no kidding. It's enough to make your head spin trying to keep up with all the headlines and the hot takes.
But we're going to do what we do best here. Cut through the noise and focus on what matters. And to help us do that, we're going deep on this report called The Month That It Was, March 2025, from the Macro Butler. You familiar with the Macro
Oh
Butler?
yeah, they're great. Really smart analysis, and they cut right to the chase, no BS.
Right. So that's what we're going to try and do today. Take this report, pull out the most important stuff, the stuff that directly affects your portfolio, and try to make sense of it all.
Yeah, makes sense of a month that felt like, honestly, like three different months crammed into one.
Exactly. So let's start with a topic that's always on everyone's mind. Jobs, jobs, jobs. February saw 151,000 new jobs, which, on the surface sounds okay. It's up a bit from January, which was revised to 125,000.
Yeah, but the devil is in the details, as they say.
Oh, always.
Right. And what's interesting here is that a lot of that job growth was concentrated in what are often considered to be non-productive sectors,
Right.
like education and health services.
Okay, so not necessarily the kind of jobs that signal a booming economy.
Exactly. And meanwhile, some sectors that are usually pretty good indicators of economic health, like leisure and hospitality, those actually lost jobs. Same with professional and business services.
So it's kind of a mixed bag, a little bit of a head scratcher.
It is. And the report even makes this tongue-in-cheek comment about waiting for the DOGE effect on jobs.
Yeah, I chuckled at that. I mean, it's funny, but also kind of scary, right? Like hoping that meme-fueled government spending will somehow magically translate into real, sustainable growth.
Exactly. It's like hoping a unicorn is going to suddenly gallop in and save the day.
Oh man, the unicorn economy. Now there's a concept. All right, let's shift gears and talk about where people are spending their hard-earned, or maybe meme-earned cash. Retail sales. So February saw a bit of a rebound, up 0.2%, but that still fell short of what analysts were predicting, which was 0.6%. And remember, January's numbers were actually revised downward, so not exactly a spending spree.
No, not at all. And if you break down the number a little bit, it gets even more interesting. Those gains in retail, they were mostly driven by things like non-store retail, like online shopping and health and personal care. But other areas like food service and drinking places, those saw a pretty decent drop, like 1.5%.
So people are maybe cutting back on going out, maybe tightening their belts a little bit.
That's exactly what it suggests. And the report highlights that food service and drinking places are a really good proxy for the services sector overall. So that decline, that's something to pay attention to.
And here's a number that definitely caught my eye. Inflation-adjusted retail sales. They hit their lowest point since August 2024. That's not just a little dip, that's a pretty significant trend. And the report calls this a warning sign for what they call the S&P 500 to oil ratio. So for our listeners who aren't as familiar with this ratio, can you break that down for us?
Sure, it's basically just a way to track how the stock market, represented by the S&P 500, is performing relative to the price of oil. And historically, when you see a drop in inflation-adjusted retail sales like we're seeing now, it often leads to a drop in that S&P 500 to oil ratio. And when that ratio falls below its 7-year average, that's often a signal that an economic bust is on the horizon.
Okay, so that's a little bit ominous. So even though we saw a slight rebound in retail sales overall, the bigger picture is maybe not so rosy.
Right, less income growth, job insecurity, it's all adding up to people being a little bit more cautious with their spending, and that has implications for the broader economy.
Speaking of ominous, let's talk about the stagflation specter. I mean, the phrase itself sounds a little bit spooky.
Yeah, it does, doesn't it? And for good reason. The report highlights that while February CPI numbers, the Consumer Price Index, those might seem to suggest that inflation is under control, they don't account for some potentially big factors that could push prices up again. Specifically, the impact of new tariffs and immigration policies.
So the whole build a wall and make them pay for it approach to trade policy.
Well, the report doesn't put it quite that bluntly, but yeah, that's essentially what we're talking about. The report actually calls this Trump reflation, which is their way of describing this kind of slow burn reflation that we've been seeing.
Okay, so we're likely looking at higher inflation. Again, my grocery bill is already plotting against me.
Yeah, unfortunately, that seems to be the likely scenario. Higher prices for goods because of those import tariffs, and services inflation is proving very stubborn, still above 3% year over year, largely due to a tight labor market.
So that 2% inflation target that everyone keeps talking about, Is that even remotely realistic at this point?
The report suggests it's increasingly unrealistic, especially with those new tariffs potentially adding fuel to the inflation fire. They even ran some scenarios, and if inflation keeps chugging along at 0.3% or higher each month, we could see CPI ranges of 4% to 6.3%.
Wow, that's a huge difference from the near zero monthly average we'd need to hit that 2% target.
Right. And they even have this U.S. Umbrella Inflation Index, which is basically an average of different inflation measures. And that's definitely not trending downwards.
So inflation's not going away anytime soon. What's the Fed thinking about all of this? I mean, they've got to be a little concerned, right?
They are. They've actually lowered their 2025 growth forecast from 2.1% to 1.7%. And at the same time, they've raised their inflation outlook with core PCE inflation, which is another measure of inflation that they focus on, going from 2.5% to 2.8%.
Okay, so they're acknowledging that the picture's not as bright as they thought it was.
Right. And they even bumped up their unemployment rate forecast a little bit.
So they're seeing some of the same red flags that we are, but here's the thing that really gets me. Their dot plot, which is basically their own projections for future interest rates, still suggests that the median Fed funds rate will be 3.88% by the end of 2025. That implies 2 rate cuts. How does that make any sense when you've got rising inflation staring you in the face? It's like trying to fight a fire with lighter fluid.
It is a bit of a head scratcher, and it really raises questions about what the Fed's strategy is here. They seem to be clinging to this idea that they can ease monetary policy, even with inflation running hotter than they expected and growth slowing down.
Yeah, it doesn't seem to add up. And then there's Fed Chair Powell's comments on tariffs. He basically said that, well, future policy depends on what the new administration does, which is kind of a non-answer.
Yeah.
But he did acknowledge that tariffs would have some impact on inflation. But then he used that word.
Transitory.
Transitory. That word is like the economic equivalent of fingernails on a chalkboard. I mean, it's just loaded with baggage after everything that's happened over the past few years.
Exactly. And the report makes a really important point about the Fed's track record. They say that despite all their efforts, the Fed has never actually managed to prevent the business cycle. They can try to smooth out the bumps in the road, but they can't stop the inevitable ups and downs.
So maybe those rate cuts that everyone's expecting, maybe those aren't actually the sign of good times ahead that some people think they are.
Maybe not. And in fact, the report even floats this idea that, get this, the Fed might actually need to raise rates.
Raise rates. Whoa, hold on.
Yeah, I know, right? It sounds crazy given the current market sentiment, but they base this argument on something called the Taylor Rule, which is basically a guideline for what interest rates should be based on inflation and unemployment. And according to the Taylor Rule, the current Fed funds rate is actually way too low given where inflation and unemployment are right now.
So the market's expecting rate cuts, but the underlying data might be telling a very different story.
Exactly. And this ties into another really important point that the report makes, which is that falling interest rates aren't always a good thing for equity investors.
Huh. I guess I always thought lower rates were good for the stock market.
In a lot of cases, they are. But it's important to understand the context. Interest rates usually fall when the economy is slowing down. So if the Fed is cutting rates, it's often a reaction to weakness, not a sign that things are about to take off.
So it's not necessarily a buy everything signal.
Right. And the report specifically mentions the S&P 500 to oil ratio. When that ratio is trending downwards and breaks below its 7-year average, which is what we're seeing now, that's often a sign that corporate earnings are going to decline. And that's usually what prompts the Fed to cut rates in the first place.
Okay, so maybe we should be a little less excited about the prospect of rate cuts. What should we be focusing on then? What's the big threat that we need to be aware of?
The report argues that the real danger here isn't just inflation, it's stagflation.
Stagflation. So we've got rising prices and a stagnant economy. That's like a double whammy, right?
Exactly. And the problem with stagflation is that a lot of the factors that are driving it are things that the Fed can't really control. Things like tariffs, geopolitical instability, government spending. Those are all forces that are largely outside the Fed's sphere of influence.
So the Fed's kind of stuck between a rock and a hard place.
They are. And the report points out that in an inflationary bust scenario, which is what stagflation basically is, neither stocks nor bonds are likely to provide very good returns, especially after you factor in inflation.
Okay, so what are we supposed to do then? Where do we put our money in a stagflationary environment?
The report offers some suggestions. First, they recommend focusing on high-quality companies, companies with low debt, low refinancing risk, and high returns on equity. Those are the companies that are best positioned to weather an economic storm.
Okay, so think quality over quantity.
Exactly. They also strongly recommend considering allocations to physical gold and silver as a hedge against inflation.
Gold and silver, the classic safe havens.
Right. And they advise being very cautious with bonds, especially long-dated bonds.
Okay, so bonds might not be the safety net that they used to be.
Right. And they also suggest looking at other hard assets that have limited supply, things like platinum, oil, base metals, agricultural commodities.
So diversifying beyond traditional stocks and bonds.
Exactly. And they have this interesting section on what they call the silver burbs warning.
The silver bird's warning. That sounds intriguing.
It is. They're talking about the gold to silver ratio, and they highlight that when the S&P 500 to oil ratio drops below its 7-year average, which is what we're seeing now, and the gold to silver ratio also falls below its 7-year average, that's historically been a signal that the S&P 500 is likely to have weak or even negative returns over the next 12 months.
So it's a more nuanced view of the gold to silver ratio than the traditional interpretation.
Right. And finally, the report points out that commodities have been outperforming pretty much everything else this year.
Yeah, commodities are definitely having a moment.
They are. And the Bloomberg Commodity Index, which is a broad measure of commodity prices, has been up significantly year to date. And the report notes that historically commodities tend to do well during inflationary bust periods, like the one that we might be headed into.
All right, so let's wrap this up and bring it all home for our listeners.
Yeah.
March 2025 was, to put it mildly, a wild ride. We saw some worrying trends in the job market, less than stellar retail numbers, and this looming threat of stagflation. And those historical market indicators, the S&P 500 to gold and oil ratios, those are definitely flashing some cautionary signals.
Right. So the big takeaway for investors is this. Focus on quality, consider the diversification benefits of hard assets, and be very selective with your bond investments. The market might be in for a bumpy ride in the months ahead.
And on that note, I'm left with this question. With all this talk about the DOGE effect and meme-fueled markets, are we overlooking other, potentially more subtle indicators that might give us a clue about what's coming next? It's something to think about. And hey, maybe it's worth taking a closer look at the Macro Butler's full report. They always have some really insightful stuff in there.
Yeah, they do. Definitely a good read.
Thanks for taking this deep dive with us. We'll catch you next time for another look beneath the surface of the markets.
See you then.